Learn how to achieve investment success by understanding market cycles. On this episode, we will learn how to make smart money choices in the current market, avoiding common mistakes. It shares interesting ideas about investing, explaining why popular beliefs about the market are often wrong, why predictions don't help much, how psychology affects markets, and how a seemingly foolish financial move can sometimes turn out great. Lesson number 1. Since opportunities to beat the market are rare, successful investing requires perceptive thinking. To succeed as an investor, you need to understand the basics. Investing is about putting money into things with the hope they'll increase in value. Successful investing means buying undervalued things, priced too low, selling them later at a higher price, and making a profit. But finding undervalued things is hard because many people are always researching and evaluating them. When an asset is priced correctly, it's tough to make a profit. However, sometimes mispricings happen. For example, in January 2000, Yahoo shares were $237, but by April they fell to $11. If you had owned the stock, you would have lost a lot of money. Mispricings like this create opportunities for big profits or losses, but spotting them is tricky. To earn higher than average returns, you need second-level thinking. Instead of just thinking a company is good and buying its stock, you think beyond that. Second-level thinking considers what everyone else thinks and realizes that if everyone already believes it's a good company, the stock might be overrated and overpriced. So you might decide to sell instead of buying, beating the market rather than following it. Lesson number 2. Understanding the relationship between value and price is the cornerstone of successful investing. The basic rule in investing is simple: buy low, sell high. But figuring out what's low and what's high can be tricky. To make smart investment decisions, you need to know the intrinsic value of an asset, which is its true worth. To estimate intrinsic value, look at a company's fundamentals, like its profit and ability to repay debts. This helps you determine if an asset is worth buying. The goal is to buy when the current price is lower than the intrinsic value. Many people ignore the crucial relationship between current price and intrinsic value. Some might say, this asset is the best, but that doesn't mean it's a good buy at any price. Just like you wouldn't buy a car without knowing the price, you shouldn't invest without checking if the price aligns with the asset's value. Besides intrinsic value, consider 2 other factors: psychology and technicals. Technicals like market crashes don't reflect value, they're just panic selling. Psychological factors, such as fear or greed, can also affect prices. For instance, during economic instability, collective fear can lead to low asset prices compared to their true worth. Lesson number 3. Dealing with risk is an essential aspect of investing. Investing involves dealing with the future, and since we can't predict it accurately, there's always risk. This risk is not always obvious, especially when prices are high due to optimism, making them more likely to fall. The belief that risk is low creates a paradox, as risk persists as long as prices can fall. In good times, risk becomes more dangerous as the possibility of loss is hard to imagine. For example, when buying a home in California, the risk of construction flaws causing collapse during an earthquake is hard to estimate until a negative event occurs. The general principle is that risk becomes evident when negative events result in significant losses. Despite being unavoidable, serious risk assessment is necessary for wise investment decisions. Since most people are naturally risk-averse, considering whether an investment justifies the risk is crucial. Risk assessment is vital because the money gained or lost in an investment doesn't indicate the initial level of risk. Therefore, risk needs to be assessed independently, separate from intrinsic value or other factors. Lesson number 4. Swooping in at the bottom of a market cycle yields the greatest opportunities for gain. In the world of investments, two key rules always apply. Rule number 1. People's behavior is cyclical, unlike machines. When emotions drive investors, it creates predictable patterns in markets. For example, during good times, access to credit increases and risk is ignored. But when losses occur, banks become cautious, leading to a credit crunch and business struggles. This cycle repeats over time. Rule number 2. Big opportunities and risks arise when people forget rule number 1. Ignoring the cyclical nature of markets and following trends blindly can be risky. This behavior leads to bubbles, where buyers assume someone else will buy at a higher price. Eventually, the cycle reverses, causing a market crash. During such crashes, investors forced to sell present a great opportunity for others to buy at a low price. Lesson number 5. If you want to make successful investments, buck the trend and seek out unusual bargains. Smart investors go against the crowd. Instead of following trends, they do the opposite, which is the key to successful investing. Crowds tend to make predictable mistakes, causing market turbulence. Markets constantly shift from overpriced to underpriced. When more people want to buy than sell, prices go up, creating a cycle. The market value doesn't change, but the cost goes up a lot. The peak of the market happens when the last person buys. At this point, the market can't go higher, so it starts to fall when someone sells. This happens because of the wisdom of the crowd, which causes these extremes. The most profitable investments are usually against the crowd, buying when others sell and vice versa. The best deals are often found among controversial or unpopular assets. Look for underpriced assets that are thought to be worse than they really are. If nobody owns something, demand can only go up. Even if the asset is initially unpopular, it can perform well if it becomes accepted. Even though it might be uncomfortable, the best opportunities are where others wouldn't dare to go. Lesson number 6. Since market forecasts are mostly useless, investors should have a good understanding of the present economic situation. Market forecasts aren't very helpful. Even though they're sometimes right, they rarely provide consistently useful information. Predicting the future is tough, and forecasts often mimic the recent past. Yet, occasionally, things change unexpectedly. For investors, it's crucial to focus on the present market situation instead of relying on unreliable forecasts. Understanding the current market conditions and considering factors like investor sentiment and media advice can guide smart investment decisions. While predicting the future is impossible, assessing the present helps navigate market cycles effectively. Lesson number 7. To achieve investment success, avoid analytical and psychological sources of error. When looking at the financial market, many people think alike and come to similar conclusions. However, even if they agree on the conclusion, they might act differently because psychological factors affect everyone differently. Big investment mistakes often happen due to psychological factors like greed, fear, ego, and envy. These emotions can lead us to chase high returns by taking on a lot of risk. Greed is the most powerful force among these emotions. It can make us ignore the usual precautions and take big risks. Fear is another strong emotion that can lead to serious investment mistakes. Instead of just being cautious, fear can turn into panic and prevent us from taking necessary actions. Apart from psychological errors, investors can also make mistakes in analysis. These are more straightforward and happen when we lack information, use the wrong methods, make calculation errors, or overlook something important. Analytical mistakes are easy to avoid with carefulness. To succeed in investments, we need to avoid both psychological and analytical errors. Why are these emotional factors important? Because investing often involves a lot of risk, especially when aiming for high returns. The desire for great success sometimes leads to failure, which can be harmful. On the other hand, minimizing risk to avoid losses may not bring extraordinary returns, but it won't lead to financial ruin. If you want to protect your money, avoiding losses is better than chasing phenomenal results. Lesson number 8. Investment outcomes often hinge on random events, so find an investment approach that anticipates various scenarios. Sometimes people take big risks and succeed. Winning in such situations is more about luck and courage than skill. Luck is a significant factor in investing. Success often depends on being in the right place at the right time, even if it's for the wrong reasons. Investment outcomes can be influenced by random events. For instance, someone may buy a stock expecting a certain outcome, but even if that doesn't happen, the stock performs well, making the investor seem insightful, though it was just luck. It's crucial to have an investment approach that considers random events, whether fortunate or unfortunate. Investors should adopt a strategy that works in various scenarios. This involves finding the right balance between taking risks for gains, offensive tactics, and avoiding losses, defensive tactics. Since not everyone can switch tactics quickly based on market conditions, a combination of both approaches is the best way to navigate different situations. Summary. To succeed in investing, you need to grasp the technical and psychological factors shaping market cycles. With various elements at play and significant risks, managing risk is vital. Success comes from recognizing and steering clear of common pitfalls. Thank you for watching. Don't forget to like, comment, and subscribe. Watch more videos by clicking on this video right over here.